Hello everyone and welcome to another episode of Meet the Manager. Today, joining us to talk about the Australian property market, we have Jason Howes, Senior Fund Manager at Dexus. Thank you for joining us today, Jason.
Pleasure, Joey. Nice to be here.
Jason, can you tell us a little bit about your background to start with? How long you've been at Dexus, what attracted you to join the firm, and maybe then a little bit about the Dexus business itself?
Yeah, of course. So look, I'm an alternatives investor of some years of standing. I've been in investment and funds management roles for 25 years, predominantly in alternative platforms. For the decade prior to joining Dexus, with global alternative investors based in Australia. And when I say global alternative, sometimes frankly you can read that as a hedge fund. But an alternatives investor is the more common description. I joined Dexus 4 years ago because of what I saw as the ingredients for success in this cycle. And so I'll just unpack that a little bit, and it's a slightly longer answer than you might have been anticipating, Joey, so I apologise. But if we go back to the last big cycle that we had in Australia, it was the global financial crisis. And the predominant business model for successful alternative investing at that point was really about buying well. It was all about buying well and popping the opportunity, the investment in the bottom drawer and waiting for the market to recover. Now that worked for two reasons. Firstly, because we had widespread, broad balance sheet distress, and we had very little alternative capital chasing those opportunities. If we roll forward to today and the market dislocation that we're seeing today, what we're seeing pockets of dislocation, pockets of stress, but not the widespread distress that we had in the GFC. And we're also seeing a little bit more competition for alternative opportunities. And so the business model that I see as the ingredients for success in this cycle is not just buying well. Yes, buying well remains important, but also equally important in this cycle will be creating value in the asset. And so what I summarise that as providing capital and capability, whereas last time around in the GFC, it was really just about capital. And so that capability component is all about leveraging the operating platform that is Dexus. And that's how we differentiate ourselves in the market, and that's how we think success will be delivered in this cycle.
Well, you've touched on a bit of the disruptions coming into the property market over the last 12 to 24 months. Can you talk about that disruption in the sense that with the higher interest rates coming in, I think there was an expectation for there to be a lot more disruption than maybe has been seen anecdotally or in valuations. Is that what you've seen? And if not, do you have any examples to the contrary?
Yeah, no. So obviously it's a great question. So let's step through what we have seen and then maybe come back to the causes of what we're seeing. So what we have seen. So at the start of this cycle, we saw the listed market reprice listed real estate assets specifically and significantly. So we saw big gaps between book NTA and trading values. Then we saw the real estate credit market reprice, as traditional lenders de-risked or managed their exposures, and the traditional alternatives were less able to step into the breach. Margins available to lenders widened as the number of lenders in the market thinned out. And so we saw real estate credit reprice. What we're seeing now, and what we've been seeing for perhaps the last 12 months, but this is still very much in progress, is unlisted real estate equity start to reprice. And so everybody will have seen valuations coming off in different parts of the market, and we believe that process is continuing right now.
When you say you've seen that, are there any live examples of that having happened?
Yeah, so I think people can look to the listed organisations to see how book values have changed over the last 12 months, and certainly that varies by sector, where we have strong performing sectors with strong underlying rental growth, such as industrial. We haven't seen the downward valuations that you have seen in other sectors where we don't have that rental growth, and where those sectors might be subject to more stress than just the changing interest rate environment. And that is the opportunity for me to come back to that cause of the stress, and the cause of that stress is the changing interest rate environment, because an increase in interest rates, and remember this is the steepest and largest rate hiking cycle we've had. When we see an increase in interest rates, that leads directly to a corresponding decrease in real estate valuations. And so in that environment, with that steep interest rate hike, what should follow is a material devaluation of real estate assets. And if you think about what environment that creates, it creates an environment of uncertainty while investors wait to land on where the long-term rates might be. And so in that environment of uncertainty, bidders leave the room. Whether they're buyers for assets or lenders, they leave the room. And so that leaves asset owners and borrowers in an environment of illiquidity. And anyone seeking liquidity in an otherwise illiquid environment ends up paying for it.
I do want to talk about valuations in a moment, because certainly that's something that I think is not necessarily as transparent as you'd expect, given what you've just said. But just going back to some of the disruptions, if we go back to COVID times and the working from home trend, again, a lot of disruption was expected in the commercial real estate market. I think we're seeing that in the US significantly at the moment. Mid-sized banks are having to be saved due to their exposures in the corporate real estate market, commercial real estate market. Vacancy rates are up at 19%. We've just seen a large Canadian insurance company mark down their valuations by up to 40%. Are you seeing those sort of trends in Australia in that commercial, particularly office space, as a result potentially of the working from home, or is the return to office saving that industry to an extent?
Yeah, so we're absolutely seeing an impact on the market. But if we unpick parts or the drivers of that impact, and I'm sure we'll come to this during the discussion, part of it is that interest rate repricing, which we've just touched on, and we can unearth a little bit later on. But to your point around the work from home and whether that is a genuine structural impact. Certainly Australia is not in the position that the United States is in terms of office attendance, but equally we're not in the position that, say, Singapore is in, where office attendance is very, very high. But there is some data that allows you to unpick what we're seeing as a bifurcation of opportunities and of values and of assets in the office market. And the first one is probably that if you look at vacancy rates across CBDs in Australia, 66% of all vacancy is in 10% of the buildings. So what that tells you is that the weakness is really quarantined or really focused on a small percentage of the office market. And our analysis shows that tends to be either poorly located or lower grade offices. And so that's where the real suffering seems to be. If you just look at Dexus's premium portfolio, for instance, we're near 98% occupied. And so that tells you there really is a tale of two cities, so to speak.
Okay. And then going back to the valuations point, it seems that in the unlisted market, a valuation only becomes true when a building or a property is put up for sale, and then you get what you get at that point, and the valuation is true. What is leading to the valuations not being valid, I guess, on when you look through pre-sale before they're put up for sale, or are they now reflecting what the true valuation should be, or is there more of that to come?
Certainly a valid question. In this country, valuations are based on historical data sets, as you say, and so in the absence of new data, it's difficult to change the value of an asset. But if you think about it from a disciplined bidder's perspective, and so if you ask how we think about that, when we're bidding in this market, we're looking through the cycle at what we see as a sustainable 10-year bond rate as a proxy for the risk-free rate. And so our bid really hasn't moved much, but the available product is coming down in price. And so if you like, the bid-offer spread that was particularly large, say 12 to 18 months ago, is certainly compressing as the market comes to a view on what the long-term interest rate environment might look like. And as a result, I would anticipate that we will see an uptick in commercial real estate transactional volume this year as the market comes to that consensus, for want of a better word.
Okay. And moving to the residential market, supply has not been there, it seems, until recently. Presumably that's because of a lot of people unable to refinance and therefore not move, and maybe demand has been propped up as a result of immigration. How do you see that dynamic unfolding? And I mean, what is what I've said fairly accurate, and do you see that changing over the next 12 to 24 months?
Yeah, entirely accurate. And if you look at RBA monetary policy statements, you'll see that dwelling investment is forecast to maintain in the subdued state that it's in today. It's the analysis that we've undertaken in particularly Sydney and Melbourne would show it to be a little more than subdued, frankly. If we concentrate just for the sake of an example on the residential apartment market for lease in Melbourne, we see over the next 2 years the lowest level of apartment deliveries in a decade. And so an already constrained supply side situation is just going to worsen over the next couple of years. And in that environment, it won't surprise you that vacancy rates in that market are circa 1%, and rental prices are escalating at double-digit rates. And so there is a real supply constraint, as you've mentioned, and that's playing out as you would expect it to in the form of rental prices. But one of the, I guess, to link that question that you've just asked and the disruption question from earlier, one of the situations we're seeing is residential developers essentially in forced sale situations where they've commenced construction at the end of the previous cycle and they're completing construction in this new cycle in the absence of pre-sales, and in the heightened interest rate environment finding it difficult to move stock and then forcing them into a position where they need to sell lines of stock in order to pay down debt. And so that's a super interesting dynamic, because what you have is really strong underlying fundamentals in the residential market, particularly based on that supply side constraint, but an environment as well where you've got forced sellers into that market. So we love that situation, we love that dynamic, and in my role, I'm certainly investing into that opportunity.
Well, that feeds straight into my next question. I was going to ask, where do you think the biggest opportunities lie? That's clearly one of them. Anything else?
Yeah, I'll take that more generally, and then we can step down. And so let's go to repricing in the market. So the repricing that we're seeing in the market is a function of both structural and cyclical repricing. So when I say structural repricing, what I mean by that is valuations resetting by reference to the now consensus view on what the long-term interest rate will be, which is markedly higher than what it was 3 years ago. Let's say 350, 400 basis points higher than what it was 3 years ago. What that means is that valuations change by reference to that interest rate, and they're not going back to where they were. That's a structural change. But what we see in that environment of structural change is we see cyclical overreaction to that change. And it's that cyclical overreaction that we seek to invest into. There's no money to be made from structural change. The money is to be made in that cyclical overshoot, and they're the opportunity sets that we're looking to buy into.
How do you identify what's structural and what's cyclical? I mean, it might be easy in hindsight, but how do you know ahead of time?
Yeah, look, maybe if I answer that a slightly different way and say that whenever we're looking for a deal in the opportunity space, there tends to be a deal attribute that lends itself to us, and so that may be a condensed time frame. It may be a forced seller. It may be that there's a breach of a lending covenant, but there tends to be an attribute to the deal that forces, at a micro level, an overreaction to what otherwise might be the free and clear market pricing.
Yeah. So you're looking at a specific opportunity that takes anything that might have been disrupted in price as a cyclical trend that will effectively reverse itself when that particular thing goes away because of the capital that you put towards the opportunity.
Perfectly well said. And we would add to that by saying that within that opportunity set, we focus on opportunities and situations where we can bring the Dexus capability set to bear. Because if you think for a moment about Dexus, I mean, Dexus is a 1,000 person organisation with assets across Australia and a leading position in each of the commercial real estate segments in Australia. And so with capability across planning, transactions, leasing, asset management, and etc., we have the ability in-house to reposition and repurpose real estate assets. And so when we invest, we're looking for that pricing opportunity that you've just mentioned, and we're looking for the opportunity to deploy our capability as well.
And so going back to the opportunities question, and you sort of really well highlighted the difference between cyclical and structural. Which other areas are you seeing cyclical opportunities come through your desk?
Yeah, so the cyclical opportunity set right now that we're seeing is absolutely in residential, and I spoke a moment ago about that opportunity set, and so we would anticipate that continuing through this year, and it will change as we go through the vertical apartment market and the horizontal land and a house and land market, but we would anticipate that trade continuing throughout the year. While interest rates remain elevated, it will be difficult for those asset owners to sell through to Australian households, and that will prolong the pressure and so continue to bring opportunity to us. So we would anticipate that opportunity set continuing. The second opportunity set that we see down that capital constrained end of the market, if you like, is around office, and you mentioned that a moment ago. At the moment, when I think about investing our fund in office, we think about credit first because we like the risk-adjusted and absolute returns available to us in office credit. And we can't yet see that in office equity, but we would anticipate that trade rotating from office credit to office equity towards the end of this year. And so that's a function of the dislocation that you're referring to. As I said before, my bid's remaining flat, but as that offer comes to me, the opportunity set is becoming real. So we have a particular recipe that we're looking for, which I'm not going to share openly here, I'm afraid. But within the office market, we have a particular recipe that we're looking for that we believe will offer us that opportunity that I've described.
So the debt against the office opportunities looking safe enough for the return that you're getting until those equity opportunities become more attractive effectively.
Yeah, and safety is of course a function of the loan to value and the terms and conditions in any loan that you make. But right now, the return that we can get for credit in office is attractive, and that's what I've been actively interested in. But like I said, that will rotate into an equity opportunity is my expectation.
And going forward, in terms of potential performance of property assets, maybe across the board or specific sectors, do you see a difference in regional versus cities and maybe across different states as well?
Look, certainly the answer to that is yes. The focus or the weight of capital dictates that the east coast of Australia attracts more capital, and so perhaps better performance. And I would narrow that certainly down to the major cities on the east coast, and those three cities are our focus. Regional assets can certainly be interesting from a yield perspective, as long as you can underwrite your ability to find a buyer when it's time to exit, and in a trading environment or an opportunities environment, ultimately you're buying an asset to reposition and sell. So you want to have a clear exit.
Jason, that's all we've got time for today. Thank you very much for joining us. That was incredibly insightful, and lots of disruption and opportunity ahead in the property market, it seems. Thank you.
My pleasure. Thank you.